In this video, we're going to complete the cash budget. We've already completed the following budgets and schedules for Grapman Manufacturing's master budgeting process: sales budget, production budget, direct material budget, direct labor budget, manufacturing overhead budget, ending finished goods inventory budget, cost of goods sold budget, the selling and admin expenses budget, the budgeted income statement, cash collection schedule, and the cash payment schedule. Both schedules are required to complete the cash budget. I've already introduced you to the basic structure of the cash budget. We begin with the opening balance for cash, add in the cash receipts to determine the cash available. We then deduct the cash payments to determine the ending cash balance. Let's complete the cash budget using the Grapman Manufacturing example. Grapman Manufacturing has the following information. A minimum cash balance of $130,000 is required at the end of each month. Amounts borrowed to cover a cash shortfall are borrowed at the end of the month in which the shortfall occurs. Repayments take place at the end of the month of repayment. Interest of 6% per year is paid at the end of each month on borrowings. Salaries, overhead, and selling and administrative expenses are paid in the month incurred. The company purchased machinery worth $16,000 at the end of February. Corporate income taxes of $135,590 are paid at the end of March. The beginning cash balance is $165,000 on January 1st. All amounts in the budget are rounded to the nearest dollar. Prepare a cash budget for the months and the quarter. There is only one step. Prepare the cash budget. We're going to use a chart. As you can see, this chart is huge, but that's because the cash budget includes details, mainly about cash payments. We'll start with the company name, Grapman Manufacturing, the name of the budget, cash budget, and then the period covered, which in this case is for the quarter ended March 31st. We have 5 columns. The first column is for descriptions of each row, so I don't add a heading. Column 2, the heading is January. Column 3, February. Column 4, March. And column 5, we use the heading First Quarter. We'll start with the beginning or opening cash, which we get either from the previous quarter's budget or from the question, which is what we'll do here. The opening cash balance is $165,000 on January 1st, so we add that under the January column. Beginning cash, $165,000. We don't know the beginning cash for February or March. That's because we have to complete the January portion of the cash budget to determine February's opening cash, and complete February's portion of the cash budget to determine March's opening cash. However, we do know the opening cash for the first quarter, as it's identical to the beginning cash for January 1st. Why? Because the first quarter starts on January 1st, so the opening cash for the month of January is identical to the opening cash for the first quarter, so we simply transfer it over, $165,000. As in the basic structure for the cash budget, we start with cash receipts, which in this case are called cash sales and collections on account. We get that number from the cash collection schedule, which we've already completed. We can simply take the amount for January, which is $2,382,720. But it would be simpler to immediately take all of the months together, January, February, and March, as well as the total for the first quarter, and transfer those amounts directly into the cash budget. Cash sales and collections on account, January $2,382,720, February $2,484,000, March $2,674,500, and first quarter $7,541,220. We now have all the cash receipts for the budget. If we add the cash receipts to the beginning cash balance, we get the total cash available. So for January, $165,000 plus $2,382,720 is equal to total cash available of $2,547,720. Can we determine the total cash available for February and March? And the answer would be absolutely not. We need the beginning cash balances for both of these months in order to determine the total cash available. So we can't do anything right now. Can we determine the total cash available for the first quarter? We can, but I'm going to leave that till the end of the cash budget. We're now going to determine all the cash disbursements, the cash payments we're going to make. We can start with the cash payments for raw materials. Where do we get that? We get that from the cash payments schedule. Cash payments for raw materials for January are $1,949,840. However, it would be easier if we took the cash payments for raw materials for all of the months and the first quarter and transferred them into the cash budget. Cash payments for raw materials are $1,949,840 for January, $1,897,812 for February, $1,979,628 for March, and $5,827,280 for the first quarter. We'll now move on to payments for direct labor. First, we know when direct labor is paid because we get it from the question. Salaries, overhead, selling and admin expenses are all paid in the month incurred. Salaries are therefore all paid in the month the employee services were used by the company. Where do we get the amount of salaries paid for direct labor? We get it from the direct labor budget. We can see at the bottom of the direct labor budget that we paid cash of $302,400 in January, $331,200 in February, and $343,440 in March, for a total of $977,040 in the first quarter. So we can transfer these amounts directly into our cash budget under cash disbursements, direct labor. We can now move on to cash disbursements for manufacturing overhead. Again, going back to the information in the question, we can see that overhead is paid in the month incurred. We get the amount incurred from the manufacturing overhead budget, from the total manufacturing overhead costs row. $129,236 for January, $132,756 for February, $134,252 for March, and $396,244 for the first quarter. Are these the amounts that we need to transfer to the cash budget? And the answer is absolutely not. Why not? Recall from the video where we produced the cash payment schedule. The planned cash outflows include payments for manufacturing overhead, but notice the line at the bottom. All expenses which do not require a cash outflow are omitted, such as depreciation. Recall from your introductory financial accounting course that the entry to record depreciation is an increase in depreciation expense and an increase in accumulated depreciation. That entry does not include cash, and therefore depreciation must be omitted from the cash budget. As you can see from the manufacturing overhead budget, a total of $33,000 of depreciation is included in the budget for every month, with the first quarter total depreciation of $99,000. The depreciation must be removed from the total manufacturing overhead costs in order to convert the total manufacturing overhead costs to the total manufacturing overhead cash outflow. I therefore add an additional row at the bottom of the manufacturing overhead budget called cash payments for manufacturing overhead. This is calculated as the total manufacturing overhead costs, which include depreciation, minus the depreciation amount. For January, $129,236 minus $33,000 is equal to $96,236. For February, $132,756 minus $33,000 of depreciation is equal to $99,756. For March, $134,252 minus $33,000 of depreciation is equal to $101,252. And for the quarter, $396,244 minus $99,000 of depreciation is equal to $297,244. We can now take all of these cash payments for manufacturing overhead and we can transfer them into our cash budget. Our manufacturing overhead payments are $96,236 for January, $99,756 for February, $101,252 for March, and $297,244 for the first quarter. We can now move on to the next cash disbursement, which is selling and administrative expenses. Looking at the question, we know that these expenses are paid in the month incurred, and we get the amounts from the selling and administrative expenses budget. Notice something important? We have total selling and administrative expenses in the last row, but we can't use those totals because they include depreciation of $14,500 per month and $43,500 for the first quarter. Again, we have to add an additional row at the bottom of the budget to determine the cash payments for selling and administrative expenses. For January, $114,500 minus $14,500 is equal to $100,000, which is the cash payment for January. February, $123,500 minus $14,500 is equal to $109,000 cash payment for February. March, $128,000 minus $14,500 is equal to $113,500 cash payment for March. And finally, $366,000 minus $43,500 of depreciation is equal to $322,500, which is the total cash payment for selling and admin for the quarter. We can now transfer these amounts to our cash budget. January, $100,000, February, $109,000, March, $113,500, and first quarter, $322,500. What other cash disbursements are there? Income taxes have to be paid by most organizations. Did Gratman Manufacturing pay income taxes? Going back to the question, we see that Gratman paid corporate income taxes of $135,590 at the end of March. So we can transfer that information into our cash budget. Income taxes are $0 for January and $0 for February, and $135,590 for March. To determine the income taxes for the quarter, we simply add all the columns. 0 plus 0 plus $135,590 is equal to $135,590 for the first quarter. Moving on, do we have any additional cash disbursements? And we do. A disbursement for equipment purchases. From the question, we know that the company purchased machinery worth $16,000 at the end of February, so we can add that into our equipment row. February, $16,000, but January and March, $0. The total equipment purchases for the quarter are 0 plus 16,000 plus 0, which is equal to 16,000. We can now calculate total disbursements for each month and the first quarter. For January, total disbursements are $2,448,476. For February, the total disbursements are $2,453,768, and for March, total disbursements are $2,673,410. We can also calculate total disbursements for the first quarter, $7,575,654. Now that we have the total cash available and the total disbursements for January, we can calculate the excess of the available cash over the cash disbursements, or, if there's a shortfall, the excess of the cash disbursements over the cash available. For January, we take total cash available of $2,547,720 and subtract the total cash disbursements of $2,448,476. which is in excess of $99,244. There is a net cash inflow for January of $99,244. Recall from a past video that cash budgets are important because organizations cannot be successful without the appropriate amount of cash. A cash budget allows management to determine an appropriate cash balance required for their short-term cash needs. In this example, Gratman Manufacturing requires a minimum cash balance of $130,000 at the end of each month. If the cash balance is less than $130,000, Gratman must borrow short-term cash from a source, such as a bank. Gratman has only $99,244 at the end of January, so they have to borrow in order to increase their available cash to $130,000, the required cash balance at the end of every month. We're therefore going to add a row with the description borrowings. How much do we need to borrow? We can calculate that by taking the amount needed of $130,000 and subtracting the amount on hand, $99,244, which is equal to $30,756. Management must borrow $30,756 in order to ensure that they have $130,000 on hand at the end of January. What interest will they pay in January on the amount borrowed in January? According to the question, amounts borrowed to cover cash shortfalls are borrowed at the end of the month in which the shortfall occurs. Therefore, management has borrowed the $30,756 on January 31st, the last day of the month. Therefore, they have not had the use of the money as yet, and interest paid is therefore zero for January. We also have a row with the heading Repayments. We can see that repayments take place at the end of the month of repayment. In January, because there was a shortfall, there is no loan repayments, and we place a zero in that column. Total financing is therefore $30,756 plus 0, which is $30,756. We can now calculate the true ending cash balance for January, which is the excess cash of $99,244 plus the total financing of $30,756 for an ending cash balance of exactly $130,000. That's what management wanted to see. We have completed the cash budget for January. We can now move on to February. The ending cash balance in January becomes the opening cash balance for February, so February's beginning cash balance is equal to $130,000. We can now add the beginning cash balance of $130,000 to the cash sales and collections of $2,484,000 to get a total available cash of $2,614,000. That's the available cash for February to cover the cash disbursements, which we already added up to $2,453,768. We now can calculate the excess or shortfall. $2,614,000 of cash available minus $2,453,768 of total disbursements is equal to an excess of cash of $160,232. This means that the company has excess cash of $160,232 for February, which means that the company has a balance which is above the required amount of $130,000. Therefore, management does not need to borrow any cash in February. Borrowings is zero. What about interest paid? We know that cash shortfalls are borrowed at the end of the month in which the shortfall occurs. So on January 31st, we borrowed $30,756. Since it's now February 28th, management had the borrowed money for 1 month, and they therefore have to pay interest on those borrowings. The interest rate, according to the question, is 6% per year, paid at the end of the month. The question also notes that all amounts in the budget are rounded to the nearest dollar. To calculate the interest paid in February, we take the borrowings of $30,756 and we multiply it by 6%, divide by 12 months to get the monthly interest rate, and multiply by 1 month. Interest is therefore equal to $154 rounded. So the amount of interest paid in February for the amount of money borrowed in January is equal to $154. This is an outflow in the grouping of both inflows and outflows, so we denote the interest payment as negative $154. That's the interest that management will pay on February 28th for the amount borrowed on January 31st. What about repayments? We have excess cash above the $130,000 required, so management can repay some or all of the money borrowed in January. Remember that repayments are made at the end of the month of repayment, on February 28th in this case. To calculate the repayment amount, we have to first determine our excess cash after we pay the interest. $160,232 excess minus $154 of interest is equal to $160,078. That's how much money we have in excess after interest. How much can we pay back? We have to take the excess cash after interest is paid, $160,078, and deduct the required ending balance of $130,000, which is equal to $30,078. This is the amount of cash available to repay any portion of the loan. Our loan on January 31st is $30,756, so we don't have enough excess cash to repay 100% of the loan. The repayment is only going to be $30,078, so we place a negative $30,078 in the repayment row. Negative because it's a cash outflow for February. How much of the loan is remaining at February 28th, since we were unable to pay the full amount borrowed? If we take the amount of the loan of $30,756 and deduct the amount of repayment in February of $30,078, we see that there is $678 of the loan unpaid on February 28th. Management will have to repay this amount in the future, perhaps in March. Total financing is zero borrowings plus negative $154 of interest plus negative $30,078 of repayments for total financing of negative $30,232. To calculate the ending cash balance, we take the excess of $160,232 plus negative $30,232, which is equal to $130,000. This is the minimum cash balance required at the end of every month. Perfect. The cash budget for February is now complete, and we can move on to March. The ending balance for February of $130,000 becomes the beginning or opening cash for March, so March beginning cash is $130,000. Total cash available is beginning cash of $130,000 plus cash sales and collections on account of $2,674,500, which is equal to total cash available of $2,804,500. We already have the total cash disbursements for March, $2,673,410, so we can calculate the excess or shortfall in cash. Total available cash of $2,804,500 minus total disbursements of $2,673,410 is equal to excess cash of $131,090. That means that the excess is greater than the required amount of $130,000, which means that the borrowings will be zero because we already have a balance that's higher than the required. How much interest is paid on March 31st? We know from when we were doing the calculations in February that at the end of February, $678 of the loan is still outstanding to be paid in March. That means that $678 of the loan was outstanding for the month of March. We therefore have to calculate the interest paid on March 31st. The remaining loan of $678 multiplied by the interest rate of 6% divided by 12 months multiplied by 1 month is equal to total interest paid on March 31st of $3, rounded. Therefore, we place negative 3 in the interest row under the March column. We have excess cash above the required $130,000 balance, so how much of the loan can we repay in March? Remember that from February, the outstanding loan amount is only $678 at February 28th. We have to determine how much we can pay this month, so we first have to determine the cash available after paying interest. Excess cash of $131,090 minus $3 interest is equal to $131,087. This is the cash available after paying interest. How much of that cash can we use for repayment? Only the amount above the required $130,000. So, available cash of $131,087 minus required cash of $130,000 is equal to $1,087. This is the amount available to repay the remaining January loan. Since the amount left from January is only $678, we have enough to repay 100% of the remaining loan. Repayments are therefore negative $678. Total financing for March is 0 plus negative 3 plus negative $678 for a total financing of negative $681, an outflow for March from financing. We can now calculate the ending cash balance. Excess cash of $131,090 plus negative $681 of total financing is equal to an ending cash balance of $130,409. This is the first month where our excess cash is enough to allow an ending balance greater than the required $130,000, although not by much. We have now completed the March cash budget. We have to move on to the first quarter. We already have the opening balance of $160,000, the beginning balance on January 1st. We can therefore calculate the total available cash as beginning cash of $165,000 plus cash sales and collections on account of $7,541,220 for total cash available of $7,706,220. We already have our total cash disbursements, so therefore we can calculate the excess or shortfall. $7,706,220 minus $7,575,654 is equal to an excess of $130,566. That's the excess cash for the first quarter. We now have to determine the borrowings for the first quarter, which is the total of the borrowings for January through March. $30,756 plus 0 is equal to $30,756. Calculating the interest for the first quarter, 0 plus negative $154 plus negative $3 is equal to negative $157. Total for the repayments, 0 plus negative $30,078 plus negative $678 is equal to negative $30,756. We now have all of the first quarter totals for financing. Total financing is therefore $30,756 plus negative $157 plus negative $30,756 for total financing of negative $157. Because we paid back the loan in full, total financing is equal to the total interest paid for the quarter. To calculate the ending balance, we take the total excess for the quarter, $130,566, add in the negative $157 for total financing, and we get an ending cash balance of $130,409. Note that the ending cash balance for March 31st is the same as the ending cash balance for the first quarter, which is exactly how it should be. That's because the first quarter ends on March 31st. These amounts should always be exactly the same, and if they're not, you know you've done something seriously wrong. This is the total cash budget for Gratman Manufacturing for the first quarter, month by month. We have finally finished the cash budget. However, we have not yet finished this video. That's because we now have to revisit the budgeted income statement. Why? We need the interest expense from the cash budget in order to determine the income before taxes. Remember that the budgeted income statement was for the quarter, so we need the interest paid for the quarter, which is $157. This is an outflow, which is why it's a negative on the cash budget. But when we move it into our income statement, where expenses are input as positive numbers, we simply input $157 as interest expense. We can now calculate the income before taxes as income from operations, $678,100, less interest expense of $157, which equals income before taxes of $677,943. We can now calculate the amount of income taxes as the income before taxes multiplied by the tax rate. Assume Gratman's tax rate is 25%. Income before taxes of $677,943 multiplied by the tax rate of 25% is equal to $169,486 rounded. This is the income tax expense on the budgeted income statement, $169,486. We can now calculate net income. Income before taxes of $677,943 less income taxes of $169,486 is equal to net income of $508,457. We have now completed the budgeted income statement. As always, thank you so much for watching this extremely long video. Sorry I couldn't make it shorter, but the cash budget is the most complex budget of them all, and critical for management to produce.